Hey guys, Dave Keller here with Market Misbehavior. This week we had the Fed meeting. Lots of earnings, particularly in the FANG sectors, and the markets are really pushing to the upside. I'm going to share with you today the most important chart to follow for market breadth. So as the markets rallied off of the June lows, over the last 4 to 6 weeks, you've seen a lot of interesting rotation in market breadth. Now, market breadth is basically a measure of participation. If the major index like the S&P 500 or the NASDAQ is doing one particular thing, what about all the individual companies that comprise those indexes? Well, we can look at all their trends individually and aggregate them in some way into a measure of market breadth. Today I'm going to share with you what I feel is the most important chart to follow right now to analyze market breadth, given the rally off of the June lows. Before we get to that, if you like this sort of thinking about technical analysis, market behavior, decision making, subscribe to my channel, would you? Also give the video a like if you appreciate it. We'd very much appreciate that back. Finally, put a comment below. What do you see as the key level to look forward to for the S&P 500 in terms of resistance and support? Let me know in the comments below. Let's get to the chart. So I have a Mindful Investor live chart list on StockCharts.com. This is one of the first charts you see as you go through the list of about 25 key charts that I review every morning. And this is looking at the S&P 500 on a closing basis in just about the last year. And then below we have 4 lines, 3 of them currently in orange, one of them in green. And just to start off, I color code these very subjectively based on my evaluation of the trends. Green is bullish, amber or orange is neutral, and then red obviously is bearish. Now, here's what the lines actually represent. At top, we have the advanced decline line for the New York Stock Exchange, only looking at common stocks. And I'll explain to you what each of that is. Each of those points mean. So an advanced decline line, every day we have a daily advancers number and a daily decliners number, right? How many stocks closed higher, how many stocks closed lower. So at the end of every day, you can just net those two out, and you have a net accumulation or net advanced decline number for the day. String those daily values together over many, many days and many weeks and many months and beyond, and you have what are called cumulative advanced decline lines. So this first one, it's all about what universe you're looking at. So the first one is looking at the entire New York Stock Exchange, but filtering out things like closed-end funds, some ETFs, some other things, and it's just common stock only, basically, classic equities. Below that, we have the S&P 500 advanced decline line, the S&P mid cap 400 advanced decline line, and then the S&P small cap 600 at the bottom. So what these are doing is basically showing the trend in breadth. And what we can do is look at what pretty much makes sense, right? As a market is trending lower, more often than not, the advanced decline lines are usually going lower as well. Part of that is just because there are more down days than up days. So you have a lot more opportunity to lose value in this reading. And also because the down days tend to be a lot stronger than the up days in a downtrend. As a result, the net result is pretty negative. In a bullish phase, like back in earlier 2021, the market's moving higher and all of these AD lines are moving higher as well. Look at a couple of things that happened, though. Here at the end of 2021, look at how the S&P made a new high. The S&P's advanced decline line made a new high. The mid-cap AD line made a new high, but the other two did not. The New York Stock Exchange AD line actually made a lower high, and the small cap advanced decline line made a lower high as well. This is an important bearish divergence that I talked about a lot with my Market Misbehavior premium members around this period, because you saw the S&P moving higher, but it wasn't being confirmed with key measures of breadth, also price momentum, looking at RSI and other techniques. As the S&P sold off through the course of 2022, you can see that the AD lines overall have been trending lower. And for most of the time, they've been below the 50-day moving averages. This last most recent bounce here in May actually saw all 4 of them get above their 50-day moving average, but only for a day or so, a day or two, before they started chopping around and very quickly reverted back below there. Now, all of a sudden, things are starting to look different. Look how the S&P made a higher low June into July. The S&P advanced decline line did, but none of the rest of them did. The New York Stock Exchange A line made a new low in July, as did the mid-cap one as well. Small caps actually made a higher low along with the S&P. So it's interesting that 2 out of the 4 actually gave a bullish divergence. And I'm starting to realize as I'm showing this chart, thinking back to some of those previous turning points over the last couple of years, this ended up being a pretty effective strategy, looking at when certain parts of the market are not confirming, in this case, some divergences where some are going lower, but others were not. Now the S&P has broken above resistance at 3,900 on a closing basis. Look how clean some of these levels are. The low close in May was right about the high there on a closing basis in late June, again, early July. Then we finally broke above 3,900 a couple weeks ago. Now we've tested the 50-day and are making a new swing high. Getting above 4,000 is key right there. I think at this point, we're sort of heading to this logical area of resistance from the 4,150 to 4,200 level. That's also the support from last March, and it's also a 38.2% pullback from January 2022 back to September of 2020. Not the March low, but the September 2020 low, which is a big multi-month consolidation period back there. If you look below here, you can see that only one of the four AD lines has made it above its June high. While the S&P still has a little further to go, most of these do as well, except just today on Thursday, July 28th, the small cap 80 line made a new closing high for the last couple of months. So the reason why this is the most important chart, I think, in terms of breadth, is to see what happens as we approach this key level. The S&P is approaching a key level of resistance. I think if the S&P would fail here and rotate lower, this would look just like a classic bear market rally, failing to eclipse its previous swing high, just like we saw back here in late March compared to the early February high. I'd also be looking at this chart to see if these cumulative advanced decline lines are able to confirm or deny any sort of breakout that we see with the S&P 500. The small cap 80 line has already broken higher. Do we see that similar sort of performance as this week and the next coming weeks start to evolve? So there we go. That is, in my opinion, the most important chart to watch for market breadth. It's all about the S&P 500 on a closing basis, which is a good way to validate any sort of moves, and then also looking at the four advanced decline lines, looking at four different universes. And as we see with the market top November through January of this year, and the market bottom so far in June and July, when some of those 80 lines don't confirm a new high or a new low, it can be pretty meaningful. I would keep an eye on this chart as July wraps and we go into August and wrap up the summer into September. For Market Misbehavior, I'm Dave Keller. Be safe and be well. We'll be back to you soon.